I finally understand options after going through the course twice. But can you explain how to determine your risk with them, please? Yeah, so Magica, so there's a couple different ways that you can control and you can manage your risk when it comes to trading options. There's a couple different ways for you to control your risk when it comes to options. Okay. Way number one is for you to sit and say, okay, I'm going to set my stop loss based on the price of the option itself, or I'm going to set my stop loss based on the underlying stock itself. There's pros and cons of each. The con and the pros of you setting it based on the option price itself. When you do it based on the option price itself, you're going to be able to control your risk definitively to the dollar that you want, which is the pro. The con, you may get stopped out of the trade based on time decay. The other way, setting it based on the underlying stock, the pro, you'll stay in the trade as long as the setup is intact. The con, you're not going to be able to control your risk exactly to the dollar, because if you get stopped out in 10 minutes or in 4 hours, you're going to lose a totally different amount of money because of time decay. Okay, so neither one is right or wrong, but there's pros and cons of each. Things that you can do that can kind of help you kind of gauge that is do delta plus sum. What I mean by that is look at the delta value of your contract. If you have a delta value of about 40, right, 0.4, that's telling you that for every $1 that the underlying stock moves, the option is going to move about 40 cents. So if you get yourself into, let's say, a SPY put option and your stop loss is $2 away and your delta is 40, then you can assume that at the absolute bare minimum, you're looking at an 80-cent loss. That's what that means. You're looking at about an 80% loss, 80-cent loss, right? But that's not really going to be your risk because that doesn't factor in time decay. It doesn't factor in implied volatility. So I like to say delta plus sum. So if you, let's say, bought a contract at, let's say, $5 and your stop is $2 away, you got a delta of 0.4, you're looking at a $4.20 stop, but that's not factoring in time decay or implied volatility. Add yourself another little buffer there. So if the delta gives you to 420, call it a $4 stop loss to account for IV, which is implied volatility, and to account for time decay. So that's how you can kind of gauge a little bit. And again, that's not going to be perfect, Magica. That's not going to give you like an exact number, but it'll help you get a gauge so that you might say to yourself, okay, well, if I'm buying it at $5, I'm figuring my stop loss is around $4. Now, depending on when you get stopped out, if you get stopped out, within the first 10 or 20 minutes, you'll lose, let's say, maybe you get out at $4.20. If you get stopped out, let's say 4 hours from now, maybe you get stopped out at $3.89, right? Like give or take a little bit based on that time decay. But that can help keep you honest in your position size so that you don't find yourself, in a position that's too big where you end up taking a loss that really ends up hurting you. That's one of the main things that a lot of beginner traders really struggle with is controlling risk on options. And they find themselves in these positions where they lose a lot more money than they initially expected to.